Australia's economy was slowing down last year. Economic growth in the September quarter printed at just 0.2%. This year, markets will be focused on whether we'll get a soft landing, the gradual falling rate of inflation, and whether the Reserve Bank will cut interest rates by August. Well, joining me now is independent economist Warren Hogan, who's also economic advisor to Judo Bank. Warren, thanks for your time. Markets focused on that soft landing. How likely is a soft landing shaping up for Australia, avoiding that harder recession?
Yeah, look, it all looks too good to be true. I rarely like the consensus view. It's rarely right. And we have a strong consensus of the narrow path, as the RBA points out, which is this soft landing, inflation coming down and some interest rate relief coming. The risks are pretty well balanced, though. We could see the economy remain resilient, bring the RBA back into play middle of the year, and then a harder landing later this year or early next year. Or alternatively, you could easily start to see this economy really build up some downside momentum. I'm less worried about that one, but the reality is the consensus is rarely right. And so far, the data we've seen over the last little while, the Christmas sales, says there's still inflation around and the economy's not falling off, really slowing down too hard. So I think it's too early to be comfortable in that soft landing view.
One warning sign could be insolvencies. We've got a chart we can put up showing insolvencies. You can really see that strong increase since 2020. So what does this mean for business sector and the labour market?
Yeah, so we not only had the lull in insolvencies during the pandemic, they've been slowing down with low rates ahead of the pandemic. So we potentially have this sort of accumulation of zombie firms, weak firms, and we're seeing as rates go up, as the ATO gets a little bit more assertive around picking up tax bills, the insolvency rates picked up last year. This is the key swing factor for me in 2024. If this really continues to rise, this could actually get the economy quite soft as businesses fail and people lose their jobs. This thing has to be watched. But that being said, insolvencies are usually into a weak economy. We've actually got a lot of labour demand. So maybe those people who lose their jobs as business fail get other jobs elsewhere because of these labour shortages. But I think the insolvency story is critical to the macro economy in 2024.
On Thursday, we get the December unemployment rate numbers. Consensus seems to be rate will remain flat at 3.9%. Some small numbers of jobs created. But how much are you expecting that unemployment rate to rise this year?
Yeah, it's probably going to go up. The increase we've seen from the lows, around 3.4, 3.5, up to 3.9 in the last 6 months, has really been driven by strong population growth, the pickup in immigration. We've been getting job creation all through the back half of last year. In fact, the November numbers were 62,000. October was 40,000.
Really big.
Yeah, really strong numbers. And I wouldn't be surprised to see a big negative number this month. The market's expecting a small increase, but no one really knows. So we'll wait and see. I think the dynamic's shifting, though. Immigration's slowing. Population growth should slow. It's all about what happens with employment. And really, to get the soft landing, to take that pressure off the labour market and inflation, you're going to need employment to be soft this year, like very little growth at all. And we're not seeing that in the data. And in fact, job vacancies today, or job ads...
We got a chart we can show with job vacancies. It looks like they are starting to turn down.
They started turning down from about mid-22.
Yeah.
But the reality, you look at this chart, they're miles above their long-term trend. This is going back to 1979. We've seen lots of volatility in the economy in that last 40 years. We've never seen anything like it. This is not a cyclical issue, the labour shortages. It's not because of the pandemic and the borders being closed. This is structural. This is the retirement of the baby boomers. This is rising dependencies. This is labour shortages here to stay. This, of course, is what could prop the economy up for a number of years because people literally, if they lose their job, they've got another one to go to. So this is another key macro variable for me. And so far, it looks like it's going to prop up the employment market.
And then the end of this month, US Fed, first board meeting of the year on the 31st of Jan, I think we'll hear from Jerome Powell, a week before the Reserve Bank. But inflation in the US, it's bounced around a bit, kind of like Australia. What are you expecting? When is the Fed going to start cutting?
Look, the US inflation story is a lot better than ours. They're more advanced, but I think their economy's got less inflation pressure in it than we do. And the PPI on Friday night confirmed that with a sort of a much weaker reading. I think it'll be really interesting what the Fed does. They were quite dovish at the last meeting, set the markets alight.
Yeah.
They've got to be careful this time. I don't think they've got any plans to cut rates in the first half of the year. I think they're going to be slow to move. I think they will move later in the year. But the commentary and the way that the chairman positions it will be critical. my view is that the market's way too aggressive on rate cuts in terms of timing. It'll happen later, and also number. They're not going to get 6.
Warren, thanks so much for your time.
Thanks, Ed.